today we will be covering class 7 of the Money IQ class. It's about halfway through the classes, or the course, I should say. It's a 14-week course. We missed one class because of not that we missed, we skipped 1 week. We will have been in class 8 right now, but because of the winter storm in February, we're in class 7 instead of being in class 8 as of right now. So today, we will be summarizing that first half of the class, which has been targeted towards helping us all to come to the same level when it comes to financial planning, helping us to understand what to look for, helping us to understand the different types of investment vehicles. The next half of the class will really then focus on finding good investments, and executing your investment plan. That will be the focus of the second half of the class. So this first class is really to bring us all to a good level when it comes to understanding financial planning, and also uh, uh, when it comes to finding out what our goals needs to be on the long run, and making a plan, setting a plan in place to that effect. That's been what we've covered essentially for the first half. So one key point I'll be making, I'd like to make as I talk about this class today. Again, it's a summary of the first half and helping to kind of step into the second half of the training. I've said quite a bit that our investment needs to be long-term focused, and we should not allow fear to drive our decisions. That is what I've seen as being the biggest challenge with many that want to be investors. They allow what they hear other people say to drive how they act and how they react when it comes to investment decisions. You will have opportunities come across your plate. You need to be able to evaluate those opportunities, effectively, which is really the second half of this class, of this course, of this training. How do you do that? Now we all know the different types of investments that's available. We all know we need to be balanced across different asset class, different kinds of portfolio classes, and across nations at this time. But in the process of doing so, what should you do? What should you not do? So one key point is don't be driven by fear, but by sound financial wisdom. Don't let fear be the driving factor for your decision making. Most people they listen to the news and the stock market is down. So in fact, I've had people say they don't want to invest in stock because stock goes down or stock loses money. And I tell people that is founded on kind of not knowing what one is talking about. The truth, as I've showed us in this class, is that stocks, for the long run, is where you want to put your money for the best return for your investment. With an average return of about 10% per annum annualized, it is the best place to keep the bulk of your investment, especially if you're a young person or middle-aged. When you start getting towards the age of 60 plus, then you need to make sure you are more balanced towards cash and cash equivalents, because you may need that money in the short term compared with someone that is in their 20s, their 30s, or maybe even 40s. So the key thing is to be long-term focused, and don't let what you hear on the news, the stock market is down, don't let it drive your decision making in any way, form, or fashion. In fact, I said this in one of our classes, and I'll repeat it here again. Now, when this market is going down, when I say market, I mean the stock market or investment market, whatever investment market is, maybe real estate is a market, they all behave in different ways, that is stock versus real estate. When those markets are going down, that is one of your best investment opportunity. One of your best investment opportunity. And what most people do in those times is that because the market is going down, they sell. When you sell, especially when you have not made profit, you are locking in a loss. I mean, for me, it's such a wrong action to take. When the market is correcting or going down, that is when, like most women say, stocks are really on sale for that time. And you want to take advantage of such times and buy more rather than sell what you have. There are two terms I want us to be aware of. You will hear it in the market. When the market falls about 10% from its peak, that is termed a correction. Okay? Markets will always go through a correction at least once every year, if not more. At least one time a year, the market will fall 10% from its peak. Like the Dow Jones is in the 30,000 range right now. If it falls from 30,000, I think it's like 31, 32, whatever the number is. If it falls by 10% from, let's say, 30,000 to 27,000, that is termed a correction. If that correction is up to 20% from its peak at any point, it's considered a bear market. Okay? And then the bull market is essentially the opposite of a bear market. This is when everybody is excited and buying. And as a result, the market grows up in value about 20% or more. That's a bull market. Everybody is rushing in like bulls do and trying to participate in the market, thinking they don't want to lose out on the good thing. It's so funny. When at that point, when everybody is exuberant, that is actually the opposite of what people do is what you should be doing. Everybody is trying to get in and sell. If you had bought when it was down, then you will have been able to sell if you wanted to sell at that point in time and be able to make some good returns on your investment. So you need to think about the fact that your action needs to be contrary to what most people do if you're going to be a successful investor for the long term. Okay, please keep this in mind. Don't make fear-based financial decisions. The market going down is normal. In fact, most corrections last less than 2 months. It will happen at least once a year, and it hardly goes over 2 months. And, there are corrections that will be over 2 months, but most will go less than 2 months. Yes, Big Mom, I see your hand. You have a question.
Yeah, how often do you have correction?
Correction.
Yeah, does it happen like multiple times in a year?
Every year.
Every
year you will have at least one correction. You might have more than one a year. It depends on what's going on in the market, in the different countries. Like last year, we had actually a true bear market occurred last year with COVID-19. If you look at the value of stocks, it fell over 20% in that March timeframe of 2020. And I told people, when everybody was afraid, that was the biggest opportunity to invest. Unfortunately, many people did not invest at that time, and lost that opportunity. I was sharing with someone, one of the stocks that we bought at that time made such a good returns, for us. There is an investment we have right now in our portfolio that the only thing that we have invested in that particular stock right now is only profit. We have already sold to take out our capital. So, and I'm talking about thousands of dollars. And it's because of that opportunity of that season that stock went really way down. It was obvious to us that was an opportunity, so we invested. And when it went to a good level, we sold enough to take out our capital and left the profit, in that investment to continue to grow, and it's still growing from our calculation, from my estimation. And I'll be explaining how to make this decision or understand these decisions to us later. That stock still has about potential of growing up to about $30 to $40 per share more. And if I was scared, there's no way we will have had that opportunity. So when everybody is running away, that's when you want to run in, because stocks are going to be lower in price. And when everybody is running in, that is when you actually need to be cautious. Where this, someone said, Bill Gates, actually, not Bill Gates, Warren Buffett said, be fearful when everybody is greedy, or be greedy when everybody else is fearful.
Mhm.
In John 12:24, the Bible says, most assuredly I say unto you, unless a grain of wheat falls into the ground and dies, it remains alone. But if it dies, it produces much grain. You know, even when your stock or investment seems to be going down, consider it as a grain of seed that is in the ground that is gaining life, even if it feels like it is dead. Eventually, even if it's dead, it will yield fruit long term. Stay in the market long enough to maximize the power of compound interest. If not, it's like pulling your seed out of the ground before it has the opportunity to germinate and bear fruit. Okay, so like I said, today I'll be speaking more philosophically, if you want to say it that way, uh, and share things that has helped my investment with us. And then this is very important. You know, as much as we have been talking about money and finances, really and truly, the goal of being blessed as God blesses you is really to be able to be a blessing to others, be a blessing in the kingdom of God. It's not about acquiring money for the sake of it. It's more about increasing your capability or capacity to be a blessing. That's the way I want us to look at it, because I know if you follow these things and you lay it to heart and you follow it, God will bless your investments over time, you know. But as God does so, let's be givers, you know. Someone says, Winston Churchill of the UK, so Winston Churchill said, we make a living by what we get, but we make a life by what we give. Let's always keep it in mind that it's really about being a blessing. The objective of wealth is not how much we get, it's how much it allows us to really be a blessing to others. You know, truly that is where the joy is. It's in being a blessing either to the kingdom or to those, to other people that might need what God has given you the grace to have. It's very, very important as we continue in this investment journey. I've said this quite often in this class, that we maintain at least a 10-year time frame. Now, it doesn't mean you will leave the investment, all the investment for 10 years. But when that is your mind frame, it allows you to be relaxed. I'm not looking to sell tomorrow. If opportunity comes and I need to sell because of one reason or the other, that's fine. I've made my profit and I'm willing to move on. But if that is not the case, you're not under pressure, because your time, your focus in terms of time is not like 1 month. We're not selling, provisions or small things here. You're investing for the future, for the long run. So please keep your mindset at least 10 years horizon. Okay. Again, it doesn't mean you can't sell before 10 years. It's just that's the mindset you have. You are long term. You want to keep your taxes as low as possible. And when I spoke to us or taught us about mutual funds, I spent quite some time talking about taxes, trying to keep it low by avoiding frequent trading, limiting the turnover ratio, looking at the turnover ratio for the investment that you're picking, and avoiding investment that have high turnover ratios. That's very important. And last week also, I showed us about on the different tax, ranges that you fall into. Uh, when you sell investments, it will put you in one bracket or the other, and that will define how much you pay in taxes, not for your 401ks and retirement savings, but on your general investment accounts. And it's absolutely important that you apply these things. And first step to do that, I asked this question, at least I know I've asked this question not less than twice in this class. or made this statement rather, that I want everybody in this class to open an investment brokerage account. The last time I asked, I think everybody said we have opened an investment brokerage account. Please, if you still have not done so, I strongly recommend, even if you don't have any money to invest in it right now, just open the account. A 1,000-mile journey begins with the first step. The first step is opening. I'm not talking about your 401k account if you have that with your employer. I mean a general investment account where you can buy the different types of asset classes that we covered last week and the week before and invest in them, for the long run, for your own portfolio. In terms of managed funds, I've also asked us to stay away from mutual funds that are actively traded. Again, I just said that earlier on because of the turnover rate. Okay. I also said we should maximize our contribution towards tax-deferred investment. I know that we spent quite a bit of time. I even have an Excel that I use to explain the power of taxes. So please remember that as we go along. I bolded a few points here. Don't lose money. It's so important when your stocks is down in value compared with what you invested. That's not when to sell. You're locking in your loss and you're losing money by doing so. Wait. It's counterintuitive. People don't want to lose money. I invested 1,000 and now it's worth 600. I better keep the little 600 left. That is so wrong. The moment you do that, that means you've lost 400 forever. And the opportunity that 400 brings to you to grow some other money in the future with compound interest, you lose it. Don't lose money. You need to be diversified. I've talked about the different level of capitalization, market capitalization, that you should have assets across all the different classes and within each class, and as well as diversifying across countries. Funds helps you to diversify across countries because those funds, because of the money they have, they can invest in different things across different countries. Keep those in mind. I strongly recommend that you invest continuously and don't wait for the perfect timing. Most people that want to be investors are looking at, when is the best time? When is it cheap? There is nothing like a cheap stock. I tell people all the time. A stock that is sold for $200 per share could be cheaper than a stock that is sold for $1 per share. Because it doesn't matter if it's sold for $1. If you lose that $1, it's 100% you just lost. Most people are thinking if it's $1 per share, then I can buy a lot of shares. That's so wrong in thought. If that company is not an investable company, don't invest in it because the price of the stock is low. You invest in a company when you buy stocks. I've said that also before. So you need to investigate the company, and that's what we'll start from the next class. How do you investigate the companies to take your investment decision? But I made this point also at the beginning of tonight's class, that even though we don't want to time the market, when opportunities present themselves with the market going down, that is when in the lingo of investors, they say there is blood on the streets at that point in time. Everybody else is bailing and selling their stocks, their mutual fund, their index fund. You, if you have an investor's mindset, that is when you go in. I don't know if you've heard the name Sir Isaac Templeton. I think Isaac is his first name. Templeton is a popular name. It was the one that, I believe, Vanguard Fund was the one that created that fund. That man went into the market. He was a believer, a Christian investor. I went into investing during World War II, either World War II or World War I, one of those world wars, when everybody was selling their stock. He was looking for investment opportunity. It's no longer around today, but I mean, it's the one that really started one of the biggest investment management firm today through taking advantage of when everybody is scared of investing. So when people are running, you look for good opportunities and invest. You know, I've said this before, be educated. To also drive home a few points, again tonight is going to be a little bit more philosophical, and then we'll look at real estate. You want to scrutinize your expenses, you know, anything over your regular, you know, what we call your run, your burn rate. Really, we talked about that quickly. You know, the minimum expense you need to live. Anything above that, you want to scrutinize it very well. Most successful people financially speaking, they are not they really watch their expense. Uh, Warren Buffett, I think most of us on the line will know that name, Warren Buffett. He used to be the richest man in the world. Other people have kind of overtaken him now. He's only an investor. Lately his investment has become so big that he's buying companies and all that. But what he started with was buying stocks. And Warren Buffett, until the house he's living in right now is the same house that he bought maybe like 40 years ago. He didn't sell it. When God blessed him and he became a multi-billionaire, he didn't sell it and go and buy a big house. And that is what most of us do. As God increases, you know, most people, they want to live at that next level. And that, of course, has its cost to you. You know, he still, somebody asked him, he was still driving a Honda Accord. I think the Honda Accord was, I don't know how many years old, but just as an example, a billionaire of his level, if he's driving a 10-year-old Honda Accord, someone said, why are you still driving this car? His response was like, because there's nothing wrong with the car. You know, that the car drives well, it takes him where he needs to go. Most of us, it's not only car that we will buy, we will even buy uh, even a jet or something like that. Let's watch our expenses and the difference, let it become investment for the long run. An example I have here is that, you know, let's say if you make $500 a week and your cost of living is 400, that means it gives you an opportunity to save 100. If you spend that $100, 1 week of your life is gone. 1 week of your life is gone. It's going to take you a week to make that $100 that you just spent back. So it's really life that using up when we spend above a particular level. Of course, like I've always said in this class, it doesn't mean you should then become a penny pincher and not spend. And like I also said also at the beginning of this class, the whole objective of our growth financially should be to be a blessing. Should be to be a blessing. It doesn't mean because we're talking about growing our financial base and asset base, you see someone that is in need. I know I'm trying to grow my asset base, so I'm not going to help. But there's a need in the work in the kingdom of God. I want to grow my asset base. I don't want to help. You're actually taking out the opportunity to be blessed because there's so much blessing in giving. The Bible says it's more blessed to give than to receive. So it's not just acquiring and uh, putting numbers in the bank. That's not what it's about. It's about growing our capacity to be a blessing, both in this generation and the generation beyond us. You know, to be able to do that, you want to be careful with what you spend money on. You know, there's so many opportunity to waste, you know, so much opportunity. I mean, if you're not careful, they will rope you into it before you know what is happening. And once you have signed on the dotted line, that is it. You are roped in, you know. If you listen to the TV, there are so many, come and buy this new car that just came to the market, this new model, or come and change your furniture. What's wrong with the one that I have? If you buy it now, you don't need to pay for the next 5 years. The truth is they won't tell you that those periods that you're not paying, they are actually calculating the interest due. And at the end of that 5 years, they put that back on the principal, and it now, becomes the new principal on which interest is now calculated. They capitalize your interest that you should have paid that you didn't pay. So $10,000 furniture that you failed to pay off in, let's say, the 2-3 years they gave you, if you still have 7,000 balance, the interest it has earned in that period may be another 3 years, 3,000. So you're back to your 10,000, and then they start compounding it from there. Don't let those things, entice you. I said it's like eating dessert before dinner. It ruins people's life. Okay. I've said this quite a bit. Maintain a long-term perspective. Let's learn to delay gratification. Let's discipline our appetite and always think in terms of the primary and the secondary consequences of the things that we do. Short-term gratification means long-term loss in the long term from a secondary perspective, whereas delayed gratification means long-term reward from a secondary perspective. Let's always think about, what is the consequence of this action that I want to take when we have those opportunities to buy things. All right. So that is just to kind of summarize some of the key points that I've been talking about as we went through financial planning. The next 2 items on financial planning, the 6-step process, I won't spend too much time on it because we've talked about it a little bit already. Is really to wrap up all the other first 4 items, which we have talked about: making your plan, setting your goals, and using like the spreadsheets on future value to determine what your monthly investment will be towards a particular goal, using your budgeting spreadsheet to see, okay, how can I achieve this amount that the future value spreadsheet has given me as a goal? What do I need to cut? What do I need to maintain at a particular level, and things like that? We've looked at that quite a bit for the last 4 classes, not for 6 classes. And now we are at a point that we also even know, once you have those money, where can we invest it in? We are leaping into what, the how rather, in the next class. Points 5 and 6 is really that you need to create an action plan. After you've done that future value worksheet and all of that, the goal is to create an action plan. The Bible says, write the vision down. Write the vision down. Anything that is not written down is not a plan. It's just a thought. No matter how much you think about it, until you write it down, it is not a plan. You're just thinking about it. So please write down those things. For example, you summarize your goal. Okay, now I know at the age of 50, depending on your age right now, at the age of 55, at the age of 60, this is how much I plan to have in total asset value. I know how much I need to invest on a monthly basis to get to that point. I have also decided the kind of investment that I will be putting money into to achieve that goal. So what is my first step? Okay, doing my budget, whatever it might be, towards getting towards that long-term goal. Write it down. I mean, I'm not saying you should become a financial planning person working in an office setting or something like that, but write it down in a way that makes sense to you. Summarize it on a Word document. Okay, this is my goal. This is what based on my budget. This is what we'll do. And if you're a couple, take the opportunity to actually hold a conversation with your spouse about your financial future and your financial plan, preparing for your children's college if they haven't gone to that stage and all of that. And after you've done that, put your plan to action, implement it, implement that action. Action is a passive word. Implement it. It doesn't matter even if you write it down. If you don't do what you said you will do, you will not get to where you want to get to. I strongly recommend that at least once a year, you go over your plan and re-plan the next year. Again, it's not meant to be tedious. As you know, as you begin to do it, it becomes easier for you. This is an important information I want us all to keep in mind, which is creating an estate plan. Whether we like it or not, none of us will live for 200 years. It's not it's the truth. We, we will live for the time that God wants us to be on this side of heaven before he calls us home. When he calls us home, if we're not careful, all this wealth that God helps you to create, if you don't plan for it, then government will take it over and will be the one to plan what you should fail to plan, especially in this part of the world, in almost every country, but it's even more serious in the West. If you don't plan what will happen to what God has blessed you with after you are gone, then it's tied up in what is called the probate system, which is government takeover essentially. Okay, probate is the legal system that is used to validate and recognize, the executor of a will and decide how that, if there is no will, okay, how someone's estate, you actually already have an estate, whether you realize it or not. You just may not have a plan for it. How that estate is going to be handled. It becomes a government thing. It's tied in the probate system for years sometimes. But you can create a plan for yourself. And I put here two links that can help you. LegalZoom. You can set up what they call a living will and trust. There's a lady that lost her husband at a young age. The man fell off a bike or something and died, and they didn't have a living will, didn't have a trust, and it created so much problem for them that from my experience, she wrote a book, and that book is called Get Your Shit Together. So click on this getyourshittogether.org and learn about our experience. On LegalZoom, you can create your own living will and trust pretty easily. They have lawyers that can work with you. You might need to pay a little bit, but not a lot of money at all. Okay, feel free to slow me down or stop me at any point if you have a question. Like I said, today we won't go into anything deep. The key deep thing that we will look at will be the mortgage, and I'm going to start that in a minute. This next set of information I won't spend too much time on because it really summarizes all that I've been saying for the last 7 weeks. Okay, preparing your budget, set and works towards having some money set aside before you start investing. And I said your goal should be about 6 times your bond rate, whatever your calculated bond rate is. Now, that does not mean don't start investing in 401k if your company asks that before you have 6 times the bond rate. No, you do that immediately. Immediately you have that opportunity, you do that. The reason for that is so that in the event that, let's say, one is out of work for a while, you are not tempted to go and sell your stocks because you want to maintain a long-term focus on your stocks and other investments. Selling stocks is like selling your house to pay for your food. You don't want to do that. Okay? So it's good to always set aside some savings, about 6 times whatever your bond rates or your financial requirement for a month is before you start investing. I talked about insurance. You need to obtain the necessary insurance, so that you don't have to take out of your savings to take care of eventualities. And determine your goals. I'm not going to repeat that. I've said that quite a bit. You'll find your investment mix, open an investment account, and then your monthly, target, start funding based on your goal and your capabilities and your budget, fund your investment account on a monthly basis. And this we'll be looking at from next class. How do you truly evaluate your investment? Okay. Ensure you maximize your contribution to employer's retirement plan. Start and fund college investment for your children. And the last one is what I just finished talking about, which is that it's not just a recommendation, it is absolutely required. If not, you might create a problem for those one leaves behind if you don't have an estate plan. Primarily needing will and trust. Okay, any question about that? That summarizes and ends the first half of this course, which is on financial planning. Any question, please feel free to raise up your hand and ask me a question at this point. If not, I want to go into a very important subject as we now start looking at a few other things, which is mortgage loan amortization. Any question? No question. Excellent. All right. One of the key investments that we all should target having is real estate. And the place to start in many instances for most people is their own residential property. And I tell people that with proper planning, if you know what you're doing, which is what I will be teaching this evening here in a few minutes, you can pay off most more. When I say this, people think, how can you do that? You can pay off a 30-year mortgage in 10 to 15 years very, very easily with just a little bit of understanding of how mortgages work and planning to be effective in paying off. And I will show you what I mean by that in a second, in a minute, in a few minutes rather. The way mortgage amortization sheet works is that you keep note of some of the things I will say here. 2/3 of what you pay between principal and interest, maybe even more than 2/3, goes towards your interest payment at the beginning stage, not towards your principal. Yet what you want to pay off is your principal. If you're not paying off your principal, then your loan, your mortgage stays high. If you want to pay off your principal, then you need to figure out how can you use this knowledge to your advantage. And another key point is if you pay 20% of the cost of a property that you are buying, there's what is called private mortgage insurance for those that have not purchased the house before. You won't be charged private mortgage insurance. And you can choose also not to escrow your taxes and insurance if you pay 20% down, at which point they say your loan to value ratio is 80% or less. And then if you don't pay 20% down, whenever you get to 20%, that 20% of the original loan value, you need to call the bank or the mortgage company and ask them to remove the private mortgage insurance. The private mortgage insurance is an insurance the lender takes out in case you default. It's in case someone defaults, to be able to cope their loss, or so they don't get into a situation of loss. Okay. And another key point here is if you're buying a property that is worth $300,000, you need to plan about $3,000. Close to 1% of that is what you need to know you'll be paying on a monthly basis. It's somewhere between 0.7 and 1%, depending on the interest rate and a few things here and there. So I will be showing what I have bulleted here using a spreadsheet in a minute. This is what the spreadsheet looks like. I will open the actual spreadsheet and I will walk us through it. Some of us in this class have seen this spreadsheet that I will open and share with us as a template after the class. You've seen it before. So I might be asking you to provide your inputs during this class as we get there in a minute. When I open this spreadsheet, you will see cells that are colored with yellow. Those are the only cells that you need to put some numbers in. Every other thing is calculated. All the white numbers are calculated, including everything in the output sheet here. It's all calculated. So just keep that in mind, that only the yellow cells requires your entries. Okay, so I'm going to escape this, end this presentation. Before I do that, I saw a few things that I want to make sure I correct on this quickly. Just a few stuff there. Okay, so I'll open the worksheet and walk us through it. I don't know if you are aware of some of these things, but they are very important when you're buying a home. The first thing I want to show you is this. When you purchase a home, let's say the home is worth $300,000, and I'll use 5%. If the interest rate is 5%, that's the down payment. If the interest rate is 5%, just as an example, if you scroll down to the bottom of this page, at the end of the day, let's see. Okay. In this instance, I assume that the buyer paid 3% down. So the actual loan taken is $291,000. At the bottom here, that $291,000 principal, when you have paid it off, at that interest rate, you will also pay $271,000 in interest over that period to the lender. The overall amount you will have spent by the time you pay off in 30 years is over $800,000 for that $291,000 that you purchased, 800 plus thousand. So some key information to keep in mind there. The higher the interest rate, if I put this at 6.5, for example, the higher the amount that goes in that total interest that you pay over that 30-year period. In this case, you're buying a home worth 291. I mean, your loan is 291,000, but you're giving them an interest of $371,000, and your total cost is 921,000. If you stay with the 30-year plan that they want you to stay with. Okay. All right. So what do you do when you're buying a house? When you're going through the process and you want to purchase a house, the first thing you want to find out is, can I even afford? Yes, Victor, I see you have a question. Go ahead, Victor.
So how did you calculate total cost? I understand 300 for the home cost, 291 that you rented. I mean, because it said 900,000, I think you said was total cost. So how did we get there?
Yeah, I will go through it in more detail, but I just want to show you some of the key shock value, if you want to say that.
Oh, okay, thank you.
We invested 291,000. The house is worth 300. The house cost, the cost of the home is 300,000. But you made a down payment. Let's assume you made a down payment of 3%, which is what? 9,000, right? So your loan is 300 minus 9,000, which is 291,000, right? That is the note you took. Make sense, Victor?
Yes.
All right. So by the time, if you wait for 30 years before that house becomes yours, if you start buying it at the age of 30, you will be 60 by the time you pay off that house. That is too long a time. If you wait till 40, you may not pay it off until you are 70. So, but let's say one waits for 30 years, you will have to pay off 291,000 at the end of the day, because that's the loan you took. However, the total interest that you will pay in that period is $371,000 over that 30-year period. So the sum of those two is $662,000 for your principal and interest payment. Okay. Now, that is not the only cost to the house. there's what they call PITI, Principal, Interest, Taxes, and Insurance. There will be taxes that you have to pay once you own a property, real estate taxes. In this case, in this particular example, it's $500 a month, and you see how that calculation is done. Well, over that 30-year period, it's a total of $180,000 that you paid in the real estate taxes. And this individual, because he didn't pay 20%, remember I told you, without 20% down, you have to pay private mortgage insurance. So your PMI is another $43,200. And then your insurance, your hazard insurance for the house, let's say it's another $1,200, which is $100 a month. In that 36 years, it's $36,000. So if you sum up all those costs, all those different elements in the course of 30 years, 36 years, 30 years, sorry, you will have paid a total of $921,000. Does that make sense to you now, Victor?
Yes, yes. Okay, we added the insurance and the cost. Oh, yeah, that makes sense.
It's part of your home ownership cost. So I wanted to show that to everyone because many people are not aware that it's not just the 290,000 or 300,000. It's actually 3 times that will be your total home ownership. If you stayed with paying for 30 years for that loan, for that house. So what do we do? Let's kind of back up a little bit and learn one or two things. So I've constructed this worksheet to help you to do some calculations that your mortgage company will do to you. Any one of us that has, if you're buying a house, when you get what they call there's a word they use for it, fair lending or whatever it is, estimate, when they give it to you, do the same calculation and compare it to this. The difference will be within $1 or $2. I'm telling you, because it's the same formula that they use that I've used to construct this worksheet. Okay, so go back to, I want to buy a home. I'm looking for a house, and the house I want to buy, I've chosen to buy, is $300,000. Okay. If I make a down payment of 3% of 300,000, remember all you need to fill in is the yellow cell, okay? If I make a down payment of 3%, the worksheet calculates for you what is 3% of 300,000. That's what that calculation is. In this case, $9,000. So the difference between your principal or the home cost and the down payment then becomes the loan that you take. Do we all understand that simple math? Any question to that first point? No? All right. So the loan amount you're taking is $291,000. The next thing you want to put is what is your interest rate? The current environment is one of the best when it comes to buying a home right now. If you do a fixed mortgage, not a variable rate, fixed rate, not a variable rate mortgage. The current environment is so good. For a premium, someone that has a credit score of about 750 plus right now, you will get around 2.9%. It's gone up a little bit. Just a few months ago, that same individual will have paid like 2.3, 2.2%. But it's crept up as the economy begins to recover. It's crept up. In the days of Reagan, when Reagan was president, there were interest rates to buy a house in the range of 18%. It was that high. So it's not inconceivable to expect that, this interest rate will continue to go up this year. So if you are interested in buying a house, it's probably about the best time when it comes to buying a house that we are in right now. By next year, I can almost predict, unless something negative happens in the economy of the nation that causes the Federal Reserve to lower the interest rate again, interest rate is going to continue to go up. Okay. So if you are buying in today's environment, if you have a good credit, when I say good credit, a great credit is over 70. I think does everyone, I shouldn't assume actually, does everyone understand what is called the FICO score or your credit score. Is there anyone in class that doesn't understand the FICO or credit score? Please raise up your hand if you don't understand it. Okay. So I'm going to assume that everyone in the class understand the FICO or the credit score. The maximum is 850.
Oh, Clara, you mean 700, not 70, right? I heard you say 70.
No, I didn't say 70. Okay, I said 750. So the range of the FICO score is maximum is 850. Okay, between 750 and 850 is excellent. I'm writing that here right now. Excellent. So if your score is in that range, you will get the best interest rate. And that's important because the interest rate you get determines, let me show you something here quickly. I have 6.5 written here. Look at the cost, the monthly payment that this individual that is paying at 6.5 has to pay on that 294,000. He has to pay 2,559. If in the same market someone has a better credit and is charged 3.5%, that other guy would pay $500 less a month. And all those roll down to the number that I showed us at the bottom earlier on, you know. So you want to take care of your credit. We have a system in the US that allows us to buy things on credit, essentially buying on the quality of your name, you know, standing for yourself, if you want to say it that way. So 750 to 850 is considered excellent, 850 being the max. Between 650 and 749 to 749, 650 to 749 is considered a good credit. And this person might be offered 2.5% interest rate, and they will offer this guy 3%, maybe even less, but let's say 3% or 3.5. And then between 550 and 649 to 649 is considered fair. Might offer this guy 4.5%. Between 450 and 549 is considered poor. Poor. And they will offer in the same market 5.5 or maybe even 6.5% to that individual. So the guy that didn't take care of his credit or something happened that spoiled his credit when he wanted to buy the house is paying 4% more than the guy with an excellent credit, you know. And the funny thing is the guy with an excellent credit is usually the one that can even afford to pay more, but is the one that is allowed to pay less because his credit is good. So you want to take care of your credit. It's really very, very important that you take care of your credit. If there's something in your credit report that is wrong, you need to make sure you talk with the credit bureau and they remove it, they correct it. You know, you are allowed to check your credit once a year free of charge in all the 3 credit bureaus, which is Experian, TransUnion, and what's the third one? 3 of them. You're allowed to check it free of charge. Say that again.
Equifax.
Thank you, Equifax. You're allowed to check from all the 3 credits once a year at no cost. They will give you your credit report. You will still pay for the score, but they will give you your report so you can see what is in it and see if something is wrong. There are organizations that allows you to check it free of charge. One of them is what they call Credit Karma. If you've not used Credit Karma, I strongly recommend it. Credit Karma will give you Equifax and TransUnion, and you can also get Experian separately, even without a cost by registering with them. Okay, so you don't even need to wait for the annual free credit pool to check your credit. Okay, but let's just see the difference between these three individuals in a minute. We'll come back to this table. I'm going to clean it off the template when I send it to you, but we'll come back to this table. But you can see, I want you to see the effect of not managing. If you have less than 450, it's not you don't have a credit. It's that you just started building your credit or you are not credit worthy. All right, so let's assume this individual falls in this second range of good, and as such, they offered him 3.5% in the current market. Okay, that's about what a good credit will give you today. If you have an excellent credit, you probably, as of today, be in the range of 2.9%, or I'll leave 2.5 there for now. So this, you need to fill the yellow. Let's say that this is that individual, so it's good, and they gave him 3.5%. The term or the length of the loan, you put that here, 30 years, fixed rate. So 30 years divided by, multiplied by 12, rather, is 360 months, okay? The interest rate of 3.5, the way this worksheet is developed, is divided into monthly interest rate. So we'll divide that 3.5 also by 12 and take out the percentage, here for calculation purpose. Okay. Another important, so when you put in all of those, the spreadsheet will show you what is your monthly principal and interest payment. You'll notice there's a formula here called PMT. It's a function that allows you to calculate the sum of any combined payment. You can use this to calculate if you're buying a car on a loan. You can use it to calculate your monthly payment on a car or a house, anything that you're paying a fixed amount on a monthly basis. The PMT function or payment function allows you to calculate the total amount that you will be charged on a monthly basis. Okay. And in this case, it's 1,306 using that function. At the time of purchase, your closing cost, and this is just an estimate here, it might be more, it might be less, depending on where you are living, where you're buying. But I use 2% of the home cost as an estimate on this worksheet. So 2% of 300,000 is 6,000. So the total cash you need at closing on this house will be the sum of your closing cost and your down payment, which is 9 plus 6, which is equals to 15. So that's all you need to buy the house that is worth $300,000. So your total investment is really the value of the house. It's all I'm saying on that point. So that's the first portion of this table you need to fill in. The second portion of the template you need to fill in is your appraised value for the tax. Your appraised value for your tax, for tax purpose, may or may not be equal to the cost of the home. Okay? If it's a new home, it might be about the same. It may also not even be reflected in the taxing authority that if property has been built on the house and they're still just charging you for the land for the first year, depending on when in the year the house was completed. As time goes on, the market value of the house goes up. So your appraised value for tax purposes also goes up. It's generally speaking close to the market value of your house, but it may not be the same. Because what the taxing authorities do is they have a budget and they want to divide that budget by proportionately equal amongst all those that have houses in that particular area. So let's say their budget is 1 billion. They divide that by the number of, not direct division, because somebody in that house, in that neighborhood might have a house worth 1 million, another one has a house worth 200,000. It would be unfair for them to just divide it equally. So they prorate it based on the value of your house. So they will first of all kind of say this is what we need, and then based on value, see where it puts them, depending on the property value, and they might adjust it a little bit here and there to achieve their own goal. So it may not necessarily be equal to your home cost. For the sake of this example, I'm putting the appraised value, because you're just buying a new house, has been the same as your home cost. On an annual basis, the taxing authority will send to you your appraised value. Depending on where you are, your tax rate will vary. In this example, I use 2% as the tax rate. Okay, so 2% of the appraised value is $6,000. All right, and then you need to pay your hazard insurance for the house, or the home insurance, as many people call it. It depends on where you're living and all of that, but I'm using 1,200 as a reasonable number for this exercise. Remember, you're filling in the yellow cell. And then the last item you need to fill in will be the PMI if you didn't put down 20%. And I make this point here that once you get to that 20%, in this case 240,000, the moment you pay your loan down to 240, you need to ask them. It doesn't automatically happen. They may not take off your PMI. You need to ask them to remove the PMI. All right, so once you put all of that in, the way the template or the spreadsheet works is, it puts here from the month one. So it's 30 years equals 360 months left. 30 years left, 360 months left. What's your loan balance? Of course, you haven't paid anything. So your loan balance is still the loan that you took in month one. And your payment, payment, when I say payment here, your principal and interest only, is this amount that was calculated with this function earlier on, which is 1306.32. Your monthly interest, which is why I converted the annual interest rate to a monthly by dividing it by 12 and converting from percentage by dividing that by 100. What the spreadsheet is doing is calculating that interest rate times your principal to calculate your interest for the month. Does that make sense? Any question on that, please ask. So it calculates your interest for the month. And of course, the principal will then be the difference between your total payment and the amount that goes towards interest. So the amount that goes towards your principal, in this case, is $458. So once you pay that, what you have left on your loan will be the principal that you started with minus the portion of what you paid that went towards your principal. So your monthly balance in month one is now $290,542. If your tax rate is $6,000 for the year, as I explained up here, the monthly payment is that divided by 12, right? So there's that formula here that is doing that calculation for you, or simply 6,000 divided by 12, okay? And then PMI, which is the private mortgage insurance, is an insurance the mortgage company have to take on the loan in case someone defaults. In this case, 120, per month. The spreadsheet just, fills that you entered up here in every month. Your property hazard insurance, again, 1,200 divided by 12 is 100 every month. So the total amount you pay a month is $2,227, and it will be a fixed amount on a monthly basis, amounting to about 0.7% of the value of your loan, okay, of that 291,000. I tell people this is usually between 0.7 and 1%. As a rule of thumb, I always just keep it in my mind 1%. So it's easy. If I'm looking at buying a house of 200,000, I should be looking at being able to pay $2,000. It might be more or less depending on one thing or the other. All right. So the spreadsheet gives you all the breakdown of what you'll be paying, and you issue one check if you have your account escrowed. The taxes and insurance will be kept in escrow for you and pays, including your PMI. Actually, your PMI does go there. PMI doesn't go into escrow. It's your taxes and insurance that goes into escrow. The PMI goes towards the insurance company. Yes, I see a hand up. Stop me. Go ahead, you're muted right now.
Yeah, okay. Yeah, I just want to ask about the property tax.
Yes.
I just want allowed to take when you file your tax at the end of the year. Can you take those out of your taxes?
Yes. Any tax that you pay during the year is tax deductible. When you do your annual tax return, that will be, taken out. You will report that and it will be taken out of your tax. You can't pay tax twice, as it were. One benefit of owning a house also is that this interest that you are paying is also tax deductible. Okay. So yes, the answer to your question is yes. Your taxes is, tax deductible. Does that answer your question?
Thank you. Yeah.
Excellent. Yeah, Matthew.
Yes, please. Could you please explain to me again the monthly interest payment? I didn't get it, and the monthly principal payment, both.
Okay. All right.
Thank you.
So, yeah, no problem. So there are 4 things you need to keep in mind. I call it PITI, or it's not me, it's called PITI in real estate. Principal, interest, taxes, and insurance. When you take a loan, that loan is called the principal, the P. The interest that you're charged on that loan, there will be a rate that you're charged depending on your credit. That rate will determine how much you pay in interest on a monthly basis. In this example, I'm using, let's say, someone that has a fair credit in the current environment will probably be paying in the range of 3.5% interest rate. If you put in that 3.5% interest rate in this template that I'm going to share with us after the class, the worksheet will calculate for you what does that imply as how much will go towards principal and how much will go towards interest. There's a function in Excel that allows you to calculate the total simultaneously, which is your principal and interest, your monthly P and I. And it's what they call the payment function or the PMT function. It takes your loan amount, your interest rate, and the term of the loan, and it spills out for you the total principal and interest payment, P and I.
Yeah.
That amount is fixed for the life of the loan, unless you refinance. It's not going to change. It's a fixed amount. Okay. However, that 1,376 that 306 and 72 that you are paying is not going towards your principal completely. It's your principal and your interest. Only a portion, depending on your interest rate, will go towards your interest. Let's assume for the same person, if he was in the fair category, the interest rate for him would be 4.5. In which case, he will pay 1,000 in interest and $383 in principal if he fell in the next category. Let's actually continue to use that for this example. For that individual, the total monthly payment is $2,194.45. That amount is fixed for the life of the loan. Okay. Now, the spreadsheet also calculates for you how much of that 1,474 total principal and interest will be applied towards your interest. That is a function of your interest rate. You see what I'm saying there, Mr. Matthew?
Yes.
Okay. So the amount out of this total of 1,474 that goes towards your interest is equals to your interest rate of 4.5% divided by 12 times your principal. Do you understand that mathematics?
Yes, I do.
Okay. So the portion that goes towards your interest is a product of your interest rate and how much you owe. So if I buy something of 10,000 and my interest rate is 10%, 10% of 10,000 is 1,000. I'm going to pay an interest of 1,000, which is 10% times 10,000.
Yeah.
Okay, it's 0.1 times 10,000 is 1,000. So same thing being done here. I'm calculating the interest. I'm just making it on a monthly basis rather than an annualized basis, which is the way it's done. So that interest that this individual will have to pay is $1,000 every month of the 1,474. So the difference between the amount that goes towards interest and the total principal and interest is what will go towards your principal, which is the principal plus interest minus the interest. In this case, for the first month, is $383.2.
Okay. Yes. Yeah. Thank you.
Excellent. And the other expenses totals to 2,100. So an important point is when you issue the check, in today's day and age, you actually pay online. You're not really issuing a check. But let's say you issue the check or you pay online that $2,194. Many people think, okay, I'm paying $2,000 towards my loan. No, you're paying $300 and $383 towards your loan. Every other thing is going towards other stuff. Interest takes 1,091, taxes takes 500, PMI takes 120, and insurance takes 100. Yes, Sister.
How could you increase the principal so that the amount will go down, you won't have to be paying?
Yeah, that's part of what I'm going to be teaching you. So the first thing I want to establish tonight is I want you to realize that when you issue that payment, only a small percentage, in this case, what is 383 out of 2? Who can do the quick math for us? Like 15, 18%, not even up to 20%, right? Of what you paid, about 17% of what you paid is applied towards your principal, you know? So the other 83% or so goes to paying other people, not you, because only your principal is paying you, which means it's reducing your, the loan, what you owe. Okay? So if you continue to do that for 30 years, like I said earlier on, you will pay off your 291,000 after 30 years. In this case, at 4.5%, you will pay $239,800 in interest, totaling $530,000. But plus all the other expenses, like we talked about, that individual will pay almost $800,000 over that 30 years on that $291,000 investment or loan. Okay, now if you know this, then what can I do? There are two ways to go about this. What some people do is they say, okay, rather than taking a 30-year loan, I want to take a 15-year loan. So you can change the term there to 15. Did you see what I just do? All you need to do in this worksheet is change your term to 15. When you do that, if you go down on the spreadsheet, there are some negatives after the 15-year mark, so you'll need to clean that out because the spreadsheet was designed for a 30-year note. So you need to clean that out to see the actual number. If not, everything will zero out and look like negative here, which is wrong. Okay. But for the purpose of calculation or illustration at this point, the first thing you'll notice is that your principal and interest, taxes and insurance total goes up from about 2,100 and so in this case by about $800 to almost $3,000. So your total monthly payment goes up, but you're able to pay it off in 15 years. Now, if you can afford to pay $3,000 a month, committed payment, it's one approach, okay? But it's not the approach I recommend because you lock yourself to paying $3,000 a month, which sometimes may become difficult, and then you're not able to pay, and then so that house may be subject to foreclosure, because you're trying to pay it off quicker than you have the abilities to pay. Okay. So in that case, more goes towards principal, but you're tying yourself, you're making a commitment to pay much more than potentially you can pay. But if someone has the capabilities, is one approach. So I'll go back to the other case, which is the 30-year note. This is what I recommend, and it's what I do. If you do a 30-year loan, you see in this case of the individual that has 4.5% that is not committing that extra $800 a month, which means he or she may not be able, as a couple, they may not be able to afford. So the monthly commitment is low. However, look at this, and I want everyone to listen very carefully to what I'm going to say next now. If you, by yourself, then decide that, okay, I have just a commitment to pay $2,194. But when this first month payment comes due, rather than paying only $2,194, I'm going to pay an additional $384.64. What you automatically do is that you remove this row from your calculation forever. And the mortgage company can no longer charge you $1,089. The interest due for that next line of calculation. They can't, because you've paid off the principal that they will have used to calculate that point. You've moved yourself to a lower principal level, which is this point. You paid off these two simultaneously. So it's going to pay 2,194. You pay 2,194 plus 384, which will be about 2,600. A little less than 2,600. Then that is month one, right? So essentially in month one, you pay off 2 months and you move from here directly down here. And you can use this brown cell to show yourself where you are. So when you pay in the end of the second month, again, you look at your table and say, okay, if I pay extra 387, I'm going to save another. So you save this the first month. The second month you save this. I will be highlighting the numbers that you are saving in the purple just to explain something to us. Then month 2, when you pay the bill, you pay extra 387. You still pay 2,194, and then you pay extra 287, again amounting to about 2,600, slightly lower. So automatically you move again. Instead of going to the next point, you move down here. So each month you're skipping a month. Each month you're skipping a month. Not only are you skipping a month, you are also saving yourself this interest. Imagine if you continue to do that every month. Every month. By the end of the year 1, you just keep adding this extra amount that goes towards principal in your calculation sheet, your template, towards your principal payment along with your PITI. At the end of the first year, instead of being down here in about 6 months, in the end of the first 6 months, I should say, you've actually paid the first year off. By the end of the first year, you will actually be at the end of year 2. You'll be at this point. You will have paid almost $9,000, about $10,000 actually of your principal. Your principal is now down to $281 rather than $291. You keep doing that on a monthly basis. But let's just assume the first year, now you just finished first year, you just own the property for 1 year. But in terms of payment, you've paid for 2 years off. But what it does for you, please listen to this, is that, you see, all this interest that I'm highlighting in purple here, you save yourself all those interest. Because you paid, in the first month you paid here, the second month, you keep paying all of that. And let's sum up all of that. Let me just highlight the purple and show you what that means. The first year, you just saved yourself Can you all see where it says sum on my screen here? Who can tell me what that number is, if you can see it? Anyone in class, please?
12,000.
$12,882. You just cut down what you have to pay the mortgage company by $12,882, and they can never charge you that amount again. That amount that I showed you at the bottom here, you just reduced it by that amount. Let's say 12,800, 12,800, just for calculation. So you reduce this amount to this minus that, and you deprive them of 12,000. So all you'll be paying them, if assuming you continue to pay at in that fashion, you reduce that to 227 and 240. Imagine if you continue to do that every month. Automatically, you cut your payment to half time. Now, the disadvantage here is that if you look at it, the amount that the best time to do this is at the beginning of a mortgage, because the amount going towards principal is smaller at that point. So you can actually advance your time faster. As it goes on, because of the way your principal is going down, so the amount going to interest is going down, the total is still the same, so the amount going to the principal will start going up. After a while, the amount going towards principal will be, after about halfway through, will be almost equal. You see that the numbers are almost equal now. In fact, after a while, it gets higher than what goes towards the principal. So it's really not to your, it's not as helpful. You have to pay more to advance 1 month as you were doing at the beginning. So what I advise people is, let's say the first year, you've already cut out 1 year. So instead of 30-year note, now you have a 29-year note. The next year, let's say at the end of that first year, you got a bonus. And listen to this, you got a bonus. You work in a company and they just gave you a bonus of $5,000, okay? What most people will do at that point is they will go to Macy's and they will buy shoes, or they change their car, they change their furniture and do all those kind of things. What you should do, knowing the power of what I'm teaching here, is come over here after you've paid your tithe. You have $4,500 left. See this section that I'm shading under your principal section, okay? The sum of that is 4,698. So I want you to be slightly less than, so that you don't use your tithe. So I will highlight that in purple again. The sum of that is 4,367. You add that amount, 4,263 rather, to the next payment. Okay, so you just add that to this 2,195. And when you make that next payment, you automatically reduce your loan by another year. Can you see what I'm doing there? At this point, you've only lived in the house for 1 year, and essentially you've paid off 3 years just by following this worksheet. You take your one-time bonuses or unexpected, income or whatever in bulk. In the early days of the loan, it's more powerful. You apply it towards your principal. In this case, that individual moved down here. He just paid this month, so it's down to the end of the, year 3 essentially. At that point in time, it's moved down over here, almost to the end of year 3. In 1 year and 1 month, you've paid off 3 years. Think about doing this. So the next year, so now you are at, year 3, at the beginning of year 3, but you've already, it's only 1 year you spent, a little over a year, 1 year and 1 month, but you've paid off 3 years. And then you continue your strategy again, okay? You continue, you keep doing what you were doing because you paid off this point, right? You keep what you're doing, you keep skipping 1 month by paying this extra on your base amount on a monthly basis. You keep paying this extra. You do that again for another year and save another 12,000 or something. And then the following year, this is now year 2, right? At the end of year 2, you get $6,000 bonus. You pay your tithe, 600, and you have 5,400. Okay, so you apply that again, and you go down here. You can see that now you're essentially at year 5. How much time has gone now? Who can tell me how much time, based on what I'm trying to explain? How much time has gone? I want someone to tell me how much time has gone from the time I bought the house at this time. There should be someone in class that can answer that question.
5 years.
How much?
5.
No. How much time has actually gone from when you bought the house? Not where are you on your payment.
Oh, okay.
I think 3.
2.
2.
2 years. Remember, the first year you advanced to the end of year 2, right?
Mm.
And then at that point you got a bonus and you applied it.
Right.
So in the end of year 1, you're actually at the end of year, almost at the end of year 3.
Year 2. Okay, yeah.
That's the end of year 1. You're at the end of year 3, essentially. Does that make sense?
Mm-hmm.
Because by the monthly payments in the first year, you didn't pay for just 1 year, you paid for 2 years. And then you got a bonus and you applied it, and that gained you another year. So you paid for 2 years and you applied your bonus and gained you another year. So in year 1, you've paid for 3 years.
Yes, okay.
Okay, then you continue your strategy of the monthly payments here. Actually, I should unshade this for a minute. Let me unshade this for a minute. You continue this again for you're now in year 2. Remember, when you finish paying this 3 years on the schedule, it's just the end of year 1. Then year 2, you now do that again. 1, 2, there are 12 months in a year. 3, 4, control. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is the end of year 2. You just finished year 2 now. Okay, you're almost at 5 years. And then usually most companies, they get bonus, right? I didn't shade it. I need to do it again. 4, 5, 6, 7, 8, 9, 10, 11, 12. I'll shade that so you can see what I'm saying. So year 2 now, you just finished year 2, you're almost year 5. And then you got another bonus. This time you got 6,000. Maybe you perform better at work. You pay your tithe. Apply. If you're buying a house, buy it. I mean, in Nigeria, what we do is we actually don't even have the opportunity to take advantage of it. We save the money and then we have to buy everything from scratch. I don't know why we now let the system stop us from doing that here. So you now got $6,000 bonus. Again, you pay your tithes, so you have 5,400 left. You bring that and you apply. You see the sum at the bottom there of the section I highlighted is slightly less than 5,004. Okay, so you apply that to it at during this next month's payment, right? And that then moves you down over here. But like I said, you've only spent 2 years in actual time. But in terms of payment, who can tell me how many years have you paid off at the end of year 2? This is where you're at.
4 years.
6 years actually, because
Yeah,
yes,
6 years.
because you are
Yes,
already
yes.
close to 24. In 2 years, you paid off 6 years, brethren. And maybe not everybody gets bonuses like that, but I know people that get more than that in bonus. I know people that it may not be bonus that they get, but some money came in from one thing or the other that they can apply. But rather than apply it, they go to Macy's. But when you think about where we are coming from, we should change our mentality. If we could save to buy a house, or build a house rather in Nigeria, we are doing the same thing. We should be doing the same thing here. I remember the first house I was going to build in Nigeria, the landlord essentially forced me. He said he liked us. We were all young then in Port Harcourt. He used to be the governor of Port Harcourt, deputy governor of Port Harcourt. So he had a very beautiful estate. And he forced me to buy 2 plots instead of 1 plot. Because I said I don't have, at that time, it was 300 and something thousand naira per plot. Imagine this was in the 1990s, mid 90s, what that is worth today. So it wasn't an easy money, 300,000, I think it was 300 or 350, something in that range. So he allowed me to pay the second instrumentally. So on a monthly basis, as I make salary, I'll take some of it to him to pay for the house, for the property. Until I paid it off, he didn't sign my payment deed. But if we could do it then, I don't know why we can't do it now. We just allow the system, then we take that money and use it on something else. Sister Bumi, I see your hand is up.
Sorry, I wanted to say 6 years when you asked the question. Sorry.
Okay, yeah, you're right. So in 2 years, you've paid off 6 years. And many people don't realize this. They keep paying only the minimum payment of 2,194. And by the end of 2 years, they're still up there at month 28. And remember that not only have you advanced by, extra 4 years in 2 years, you've also saved yourself all this interest that I shaded in purple. Those are interest they can no longer. In 2 years, you already cut the interest that you owe them by $24,000, $25,000. That's a powerful knowledge. When I discovered this, I almost jumped off from my chair, many years ago, and decided that that was the way I was going to handle my mortgage. And God helped us through it. Yes, Sister Desola. Sister Desola, you're muted.
My question is it good to refinance your house?
Yeah, it's, for example, in the current environment, let's say you purchased the house when the interest rate was high. For example, let's say it was 7%, just using that as an example. Your monthly payment will have been $2,660 for the same house, right? $2,656,000 a month, right? And then you now found yourself in year of COVID when that forced the government to lower the interest rate. And people were now able to buy houses for 2%, 2.2%. Why won't you refinance?
So that's the best time to refinance.
That is even right now, yes. When the interest rate is low, that is in fact the only time to refinance. You don't go and refinance because anytime you refinance, there is a closing cost. When you go to the market and say, I want to refinance this loan, I wouldn't do the calculation. Let's say you have to pay another $6,000 as closing. Okay. The question is, what will be the payback time on that cost that you have to pay? And how do you calculate that? The way to calculate that is, okay, you are paying 7 interest and your total payment is 2,656. So I'll put that here, 2656. Let me just copy, Control C, and paste it as values. Okay, this is what you're paying now, right? And then interest rate went down and you can buy at 3% as an example. What's the total payment then? 1946, right? Pay that. The difference between the two is this minus that cell, which is 709. Now, remember you paid 6,000 to save yourself 709.
Yeah.
What is your payback time? It's equal to how much you paid, right? Divided by how much you save on a monthly basis. So now this is showing you in dollars, but it's not dollars, right? It's months. So it's going to take you 8 months. As long as it's going to take, you're going to stay in that house for more than 8 months, that investment of 6,000 pays for itself in 8 months. Does that make sense?
Yeah.
Yeah. So that is really what you want to do. Look at what is the total that you are paying today. When you take this sheet, you just run the numbers. What is the interest rate that they are promising you? If you lock it in, you see what's the difference. And if, like in this case, is 8 months, it's more than likely you will be living in that house for more than 8 months. So your investment, you're investing 6,000, it pays back in 8.5 months. And beyond that, you begin to save $700 a month. Now, if what you get is, let's say, 5%, okay, then that number is different. Control C, very special. It's going to take you 16 months to pay that back off, right? The difference is only 373. Does that make sense? If it is 6%, I'm just putting some numbers there so you begin to see how do I decide if it's something I want to do. If it is 6%, it's going to take you 2.5 years to pay back or break even on that $6,000 investment. You know, so that's a decision. Is it worth it? Am I going to stay in this house for more than, 2.5 years? Personally, I won't even finance at that point. To see that it's only when it's very low that it pays to truly refinance, as it were. Does that make sense?
Yeah.
Good question. Imagine if you did this so this is year 2 now, and then year 3. By year 3, you do the same thing. I'm just for the sake of, because of our time, I won't do this. I won't do it all for you. When I send the sheet, you can do your own simulations also. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You do that again for another year, which is 12 payments, right? By that point, chronologically, you're supposed to be at the end of year 3. Then, but let's say this time around, you now got a bonus of 10,000. I'm just making that up. You take out your tithe, you have 7,200 left. So we'll see where that puts you on your principal scale. That puts you about here. Then you apply that again, and you're now down to this point, that next payment you're here. So by the end of year 3, you've actually paid off 9 years of your loan. Whereas your colleague that you bought the house together still has 27 more years to pay. If you do nothing more at that point, you have only 21 years to pay. He has 27, you have 21 more years to pay, which is what is shown here. So if you do that consistently, you will cut off easily about 15 to 20 years. You need to do that consistently at the beginning, 15 to 20 years of the life of the loan, the chronological life, the actual, calculated life. And you can pay most loan off, depending on how you do this, in about 10 years, even less than 10 years. Yes, Sister Shakira.
So I have a question. If you didn't do this at the beginning and you're already halfway through your loan,
yeah,
too late?
It's not too late, but you're not going to achieve the same result, right? Because in the first place, you've lost 15 years because you're halfway through, right? And then at that point in time, you are at a point where adding more towards your principal will not advance you as quickly. Think about it. At this point, let's say this is year 15, right? If I get the same $8,000 and I try to apply it, see? I'm trying to show how long it will take you after tax. It will only advance you about this same amount of time. It advances you, I think, if we count here, 9 months. Yeah, 9 months, right? But that same 8,000, think about if you applied it earlier, if if you applied it when it was in the early days here, let's see how many will get you towards 8,000. Okay, I'll put it here. 15. 8,000 advances you 15 months at the beginning. But at the later time, because more is going towards principal, then it advances you lower. You know, you don't make as much, you don't save as much time on the life of the loan. So you can still do it, but it costs you more to achieve the same result. Does that make sense?
Yes. So I have one other question, follow-up question to that. So if you're already halfway through, sometimes you want to refinance, but instead of refinancing for another 30, you're refinancing for 15. Does that still benefit you or not?
Yeah, it will. Because, okay, all right. So it depends on what you mean. If you're already halfway, that means you've already cut it down to 15 anyways.
Exactly.
So why are you refinancing for 15 when you're already 15 years off?
Because your rates are much lower than where you were before.
Okay. The commitment, though, is you are going to have a higher monthly payment. Okay. So it's another way to do it. At the end of the day, what goes towards interest will be lower. You still finish in the next 15 years, right? You pay less towards interest. So there is some value in doing that, but it will still take you 30 years. Does that make sense? Really and truly, what you want to cut down is the years, because years equals interest payment. Yes, equals interest payment. And if I were you, let's say you actually want to do that, I would rather not refinance, because you're going to take a cost of closing. I would rather just start applying a little bit more towards my principal, and cut down that 15 years to, let's say, 10 years or something. So that you pay less on the overall towards principal. Instead of 30 years, you pay it off in 25. Make sense?
Yes, it does. Thank you so much, sir.
Excellent questions. So that's really the key thing. Those are the key things that I want to share with us tonight. This is a very important information for anyone that wants to buy a house to have before buying a house. You know, because they won't tell you this. They actually don't want you to pay off, because if you do, look at you're cutting down. By the end of the day, in 3 years, you've already cost them 37 to 40,000 out of that's their interest. You know, they don't like people like that. In fact, when you're taking a loan, there's what they call prepayment clause that most people don't know that they put into the loan terms. Please, please, please don't sign any loan document that has a prepayment clause. They call it balloon or prepayment clause. What it does is they will tell you you are not allowed to pay off this loan before 20 years, for example, or 25 years. If you do, you are going to pay us this amount as penalty. What they are trying to do is force you not to pay off even if you have the money to do so that they keep the time and charge you the interest. Many people don't even read the document to know if there's a prepayment clause or not. They just sign. And once you sign, it doesn't matter. It's a contract. You've agreed to it and you have to pay it. You know. So keep that in mind. Don't ever sign any loan that has it. And it's usually on conventional loan. I see your hand, Mayokun. Just give me a minute. It's on conventional loan that they do that a lot to people that they don't know. Anytime you're going to buy a house, go there with this knowledge and be wise about what you're doing. Yes, Mayokun.
I wanted to ask if maybe this was a different option for anyone that has a 30-year mortgage. What about if you made a decision that instead of paying it at the rate of the 30-year mortgage, that you actually paid at the rate of if you were doing a 15-year instead?
So you do your calculation yourself. Okay, you
Yes.
take a 30-year note, right? And then you go home and then you put, instead of 30 years, 15, right?
Yes.
and you look at what the number is, yes,
And then you
keep the same thing, because what you are essentially doing is you are paying extra, what, 700, 600 on a monthly basis. It's more than you need to pay, but it's going to, especially in the early days, okay, it's going to accelerate you. That 600 will accelerate you about 50 days, right? Each payment. So you're doing the same thing. You're just doing it, like on a fixed scale without telling them that that is what you're doing, right? So you can do that. It's essentially the same thing. You're just, adding more towards your principal, but you didn't sign for a 30-year, 15-year note. You signed for a 30-year note, right?
exactly,
Which in
yes.
this case, you should have been paying, in this particular scenario I have here, you would have been paying 2026, but you now did the calculation and showed you 2008, excuse me, and you're putting the extra 800 on it a month. So essentially what you're doing is you are kind of doing, putting 800, this is slightly different. I was using 4.5% before, so let me continue to use that. That's 2002 versus 2800, so extra 600 will almost pay two, not just this one, almost the next 2 months, not up to two, because the two is a total of 770, right? But the difference that you are adding is around 600. So it doesn't advance you 2 months, it advances you like 50 days or 48 days or something like that. So if you do that consistently, you are achieving essentially what I just explained, but just doing it slightly differently. So you can do so. Make sense? Does that help you, Mayoko?
Yes. Yeah. Sorry. The reason I was asking is when my wife and I, when we bought our house, I was essentially the only one that was working. So we, of course, made a calculation based on my income. So, but then, she started working as well. So we've thought, okay, that we can now, instead of going the rate of the 30-year mortgage, we just put the extra from our income and just pay it like we're paying for a 15-year mortgage. And that hopefully, so that's what we've just started. We've just started thinking about doing before today's class.
Excellent, Mayoko. That is excellent. Because what you're doing is you're not committing to it by signing a 15-year note, right? You still have on paper a 30-year note. But between you and your wife, what you have now done is you're using wisdom to pay more. Even though I'm just using this example, let's say this is you and you're supposed to pay 2,200, you're adding 600 because you did the calculation and said, okay, this 600 more, actually, in this case, 700 and something, will get you to the 15-year, almost 3,000, will get you to the 15-year mark, right? So you pay that extra 700 plus a month, you are advancing your payment, Now, again, you didn't refinance, so you're not committing to this extra 1,000 a month on principal payment, right? You still are on a 30-year note scale, but you are moving. So let's say something happened and you're not able to pay that 3,000, and you can still pay 2,194 and nobody will say anything. But if you refinance and you're now committing to 33,000 and something happens, you're not able to pay, one will be in trouble from a credit point of view. Does that make sense? So I really like what you and your wife are deciding to do is along the line of what I'm teaching. This is great. I like that. Good job. Kudos to you. All right, any other question? If not, that is where we'll stop tonight. There's one other important point I'd like to make on buying a house that I want you to be aware of. When you buy a house, a new house, because that property is not reflected with the taxing authority in the first year, the appraised value it reflects. Now listen to this very carefully. If it's just the land, let's assume it's 20,000, just the land. Look at what your PIT high will be, 1,793. I'll just copy that and put it here for a minute. Okay, that's all you pay for your PITI. Okay, because only $33 is going towards your principal. Every other thing remains equal. What happens is that in the second year, the property will definitely reflect with the taxing authority, and they will take your tax up from not 30, from that $33 to $500, which is what it should be. At that point, the escrow company now gets your bill, and the bill that they are now sent is 6,000 instead of what was it before? Instead of 400, which was because the property was not reflected with the taxing authority. As a result, there's a difference between what they have been taking from you, which is just $33 a month, and the $500 which you're supposed to pay. And what they will do is, now for this, so the second year they will go ahead and pay that money for you. But now you are owing them that difference. Let me go back here and put 20,000. So 20,000. So you see, it's only 400 that they collected from you for the year. So they paid 5,400 for you. They will add to that what you now expected to pay, which is 6,000. They'll add that to it. So 6,000 plus 5,400 is 11,400. They will divide that by 12, 11,600 rather. 11,600. They will divide that by 12. Because they want to collect their home money back from you, right? And then that's $1,000. They'll add that to what you were paying. Let me put the 200 here, 20,000 here. So that was 1,700. You were paying 1,700. So what you will now be paying a month is equals to this plus 1,700. So imagine going from paying 1,700 and being very happy to having to pay 2,700 a month. For some people, that is a big shock, and there are people that in that third year of adjustment, they lose their house because they're not able to afford that, going from 1,700 to 2,700. Okay, so if that is your situation because you built a new house, just make sure you know calculate what it should be based on the home cost. Use that as your estimate of the appraised value, and pay the extra into your escrow account. Keep it there so that when they need to pay it for that second year, they have what they need and they don't raise you double. So you stay flat around that 2,200 throughout. It's an important thing to be aware of. Does that make sense what I'm trying to explain there? Okay, silence means consent.
Yes.
Okay. All right, great. That's the end of the class tonight. I appreciate everyone's contribution. This is a very important information. Like I said, when I discovered this, was actually one of my realtors. It became a very good friend that shared this worksheet with me the first time. I've gone ahead and made some changes and to it, but it opened my eyes, and it's been a blessing to me, to us, I should say. And I want you to think about it, see how you can apply it, to yourself. You may not get that 1 year bonus, like I was saying, but you can at least do the 1 month on a continuous basis and cut that down, easily cut down 10 years, easily, without any problem. Okay. So I wish you all the best as you apply this knowledge. Next class, we're going to we'll look at start looking at how do you evaluate investment opportunities now. We've talked about how do you get your money together. The question is, when you put the money together, you now know the different types of investment classes. How do you decide where to put your money? Which stock to buy, which mutual funds to look at buying, and things like that. That will be what we'll be focusing on for the second half of this training over the next 7 weeks. Okay. If there's any question, please feel free to ask. If not, we'll stop